Thank you so much for the introduction. I'm very excited to be presenting here. This is like really a great opportunity, and I'm very much looking forward the session. Especially looking forward to Sandra's talk actually. So I'm glad to be going first. Um, so what I want to talk today about is a topic that is close and dear to my heart, and that somehow 2020 and the unfortunate sequence of events that we've seen have kind of brought to the forefront, I think, of everybody's mind. And that's the ability of firms to actually access credit when they have trouble with their operations. And specifically, what I want to talk about today is the difference between small and large firms. So in the title, I'm talking about the firm size distribution. We kind of probably have an understanding that small and large firms are in very, they face very different constraints. Typically, these firms are studied very separately. You'll read an article about how small firms are struggling. You read an article about big firms. What I want to do in my present today is kind of try to give an overview, a unifying view that looks across firms of different size. And there's going to be a particular emphasis on what happens to them during the COVID episode, and their ability to access financing to keep operating and hopefully not having to downsize employment and things like that. So this is joined based on an article of mine that's joined with Gabe Chodorovic at Harvard, Stefan Luke and Matt Plosso that are at the Fed. So I have a disclaimer that I have to say that this view represents only my views and not the views of the Federal Reserve.
Olivier, my sincerest apologies for the brief interruption, but we just received a note from one of the attendees that it's a little difficult to hear you. Okay. I'm hearing you fine, but I don't know if maybe you can adjust your headphone setting
yes,
or anything to
absolutely.
enhance the volume. Thank you.
Yes. Where is my Zoom here? Maybe this is better like this. I'm just going to try to speak a little bit closer, and then if that gets much worse.
If anyone wants to write into the Q&A, just yes or no, that would be helpful as well. Then I can gauge. Okay.
Yeah. If you can hear me, Melina, I'm gonna keep going for now,
okay,
and hopefully that's okay.
Sometimes
it's on the other end. No, that's good. So the starting point is really this idea that credit is very useful, and in particular because it has a dual role. You can borrow for long-term investments. Like think, if you want to take a household analogy, you can take a mortgage to buy a house. And that's the idea. It's going to take you a lot of time to repay, and you're trying to finance one big investment. So firms do that. Sometimes they borrow to, buy another company or to build a new factory, open a new a restaurant or a new point of sales. But there's a second very important role of credit, where banks play a very special role, is the provision of liquidity when you're faced with an unexpected shock. Okay, so think in an analogy of household, maybe you can use your credit card if you have an unexpected medical bill, or if your car breaks down, then you need to take it to the mechanic. So corporations have these forms of credit as well. That's typically what we call a credit line that really looks very much like a credit card for household, where they have an account with a bank that they could potentially draw funds for when they need them. Okay, so of course, small firms are especially reliant on this type of bank liquidity to avoid financial distress when they face a particular crisis. So think, for example, the 2020 COVID shock, when revenue stops drastically and they still need to fund operations. Of course, larger firms presumably have more options, but small firms were particularly reliant on this form of bank credit. And so the question we're thinking about in that paper, and I want to discuss today, is, do small firms face tighter access to bank funds relative to large firms? And this is pretty much a question that was on everybody's mind in 2020, with some observer going as far as claiming that much of America might have been shut out of the greatest borrowing binge ever. So if you read between the lines, there seems to be a very different experience between small firms and large firms, right? Large firms were able to borrow to withstand the shock in this difficult period, where small firms were much less likely to access credit. That's the fear. And it's especially worrying because small firms really need these funds at this time. So I'm going to show you a bunch of facts related to this question, whether there's some sort of financial inequality between big and small firm and how that played out in 2020. And so for this, I just want to say that what we exploit in this research is this very novel data that comes from the Federal Reserve that gives you detailed information about firms and the loans they receive. So without going into too much detail, we can observe a lot of small firms in our data, not just big firms. That's not typically the case, but we have both. We're going to have many SMEs, which we define as firms that have total assets, book assets from your accounting class, that are not too large. We have a lot of them in addition to big firms. So I'm going to be able to do a comparison, a direct comparison between smaller and larger firms, which is not typically possible. Also, we can observe pretty good details about the type of loan contracts that they have. So the big pitch of this talk is basically trying to convince you that a lot of the difference that we observe between small and large firm can be attributed to the fact that they actually have very different agreements, very different loan contracts with their banks. Okay, they are not at all the same. And that means that actually they're going to have very different experience when a big crisis occurs. This is a big data set. So what I'm going to show you can think about being representative of a large part of the firm population. We will not have micro enterprises or very small bank in our data, as well as some things related to fees and covenant, but that's going to still be enough to draw an insightful picture. So the paper really has two parts. The first part is to think, and that's what I want to start with, some difference about loan terms between small and big firms in normal times. And then I will show you how that matters for what happened during COVID, which is extremely striking differences and inequality there. So one thing that I want to emphasize, and that we didn't really understand very well before looking at this data, is that small firms have very short maturity on their credit line. So basically, most of the firms that are small, they either have 1 year maturity or they have essentially clauses that gives their lender the ability to ask for their money back at any time. Okay, so that's very different from the big firm that tend to have about 5 year agreement with the bank, which means if they borrow, they have up to 5 years to repay. Now, this makes an enormous difference. If I'm faced, with a big shock like COVID, and I feel that I need to borrow in order to continue operating, if I know that in 6 months I need to have a meeting with my banker to discuss whether I can renew my loan or not, it's going to make me reluctant to borrow. And maybe I'm instead going to decide to fire people or downscale operation. On the other hand, if I have a contract of a big firm with a 5 year horizon, I know even if I borrow a lot today, I don't have to come and discuss with my banker for another 5 years. So that really provides very different amount of insurance. In some sense, these credit lines are supposed to give you insurance, but if they have very short horizon, they just don't give you as much insurance as you would think. So these differences are enormous and really are going to end up making a big difference. Now, that's not the only difference. One thing that's different is that small firms almost always have to post some form of collateral with their bank when they want to borrow, which means collateral is some asset that you own, maybe some of the cash that you have, some of your account receivable, some of your machines. And if you're not able to repay the loan to your bank, the bank can just seize these assets as compensation. So that's a big constraint when you're trying to borrow, of course, because the banks always needs to check that your collateral is good enough relative to what you're trying to borrow. So that's another way in which these credit lines can actually be constrained and not give you so much liquidity as you might need. Large firm, on the other hand, they very often borrow unsecured, which means the bank doesn't really have to verify whether they have enough assets to back their borrowing. Now, a third fact that is interesting is that, in spite of these, small firms still end up using these credit lines more. So if you want to think about a credit line, remember, it's a little bit like a credit card. You have a balance that you can draw on if you need. So usually we calculate what we call the utilization rate, which is how much of your balance are you using at any given time. Okay? And what happens is small firms actually, they do use these credit lines more. Their utilization rates are quite high. And that's, in spite of them having worse term, shorter maturity and more collateral. I don't want you to think that the loans that small firms receive are so bad that they never end up using them. No, they do use them, in fact, more than large firms in normal times. We'll see that this is important because in bad times, like during the COVID episode, this is going to reverse completely. And then a last fact is that these loans on small firms are actually quite expensive. So they pay what we call the higher credit spread, which is the interest rates, if you want, that they pay over some benchmark rate. And that's even conditional on bank characteristic or which industry they are and things like that. So what's striking about that is that it paints this picture where firms have kind of worse loans, but they still pay more on them. So it's not like, you know, they get a benefit of a cheaper cost of borrowing for having this stricter loan term. That's not what happens. In fact, it's as if small firms are choosing loan terms from a completely different menu, if you want, relative to large firms, right? So they completely have access to qualitatively different loan contracts. And you know what I want to convince you is that this difference in contracts are not just an institutional details. They're going to matter enormously when you're going to reach a crisis state like 2020. So let me summarize this contracting view and draw some implication for bad times. So really what these four facts are showing is that small and medium enterprises have actually credit lines that are less committed than large firms. Less committed in the sense that, yes, on paper you might have funds, but when you actually need them, you might actually not be able to access them. And the idea is, some of these loans have a demand. They are demand loans, which mean the lender can ask you to repay them at any time. They have short maturity, so the lender might refuse to roll it over and renew the agreement the next year. They might revalue the collateral and say, you don't have enough security to borrow. And all of this is improving the lender control right about how much you can actually borrow. Okay, so it's a little bit as if, take a household analogy, that whenever you have your credit card, if you try to make a big purchase, your bank is actually call you and say, no, actually you can't do that big purchase. I'm just not sure that's the right thing to do. And so that's like going to be a real constraint for a small firm in bad times. Larger firms, on the other hand, they don't have these types of constraints in their contract. And in a sense, it means they have much more liquidity insurance. These banks' loans give them insurance against them being hit by unexpected shocks. Now, of course, I'm an economist, so I like to try to think about it as an optimal equilibrium model of contracting. So in our paper, we do that. I will not, do any equation today, of course, but there's a sense in which this arrangement, although it looks unfavorable to small firms, it can be rationalized. There could be some reason for why that's the case. And one clear reason is that small firms tend to be, and that's clear in the data, just more risky, and they have more uncertainty around them. Okay, so for example, their income tends to be more volatile, their financial statements are less likely to be audited, so we're really not sure how reliable the numbers really are. And in that world, in that setting, it actually makes sense for a small firm to give more control to the lender relative to what a big firm would do. And the upshot is that this is going to give more credit to the small firm in normal times. And that's what we saw in the fact number 3. So there could be a rationale for this difference in terms. The problem, though, is that can backfire in bad times. Okay, although that could be better for good times, in bad times that can backfire. And essentially, it means that what you really have available as a small firm with your bank, de facto, tends to be quite a bit smaller than what you have on paper. Okay? So if firms pick different types of contract, then they will have different access to liquidity in crisis, and small firm may not be able to draw after big cash flow shocks. And so that's why I'm going to turn to look at the COVID episode. So what happened in 2020? So I'm sure most of you have some, I heard some of these stories, but for those who have don't, let me start with the very big picture. There was a ton of lending by banks during this period. So if you haven't seen the graph, this is how it looks like, official data from the Fed Reserve. This is bank lending in 2019. And then just in the first quarter of 2020, as the COVID shock hits and the economy goes haywire, there's a massive increase in bank lending. So, the point of this paper is to try to understand whether firms are able to borrow from bank in this time. And the answer is, in the aggregate, yes. But what we don't know is this driven by all the firms or all the firms participating in this wave? And our microdata allow us to answer this question. And the answer is a resounding no. Basically, this entire wave is driven entirely by big firms using their credit lines, and small firms have virtually no increase in bank credit. So without going through the number, this is what this table shows you. It's very, very striking. Yes, firms were able to borrow a lot, but it's virtually entirely only large firms, and small firms, very little. So why is that? So, one thing that we would like to rule out, and I'll just show you this picture to explain that in a very simple way, is that, well, maybe this is not because of the loan contract differences across small and big that I talked earlier. Maybe it's just, maybe big firm needs a lot of funds and small firms don't. I don't know. That could be one reasonable hypothesis, something that we'd like to rule out. Well, depending on your view on the topic, you might agree or disagree with that, but we feel that we need to dig further to see whether that could be a reasonable explanation. And the answer seems to be no. Just difference in funding needs between small and big firms would not be enough to explain the big difference in borrowing between the two. So let me just explain this one picture that is very striking. So what we do here is we sort firm according to how exposed they were to the COVID shock. We use a measure based on how much employment decline there was in this industry, if there was a lot of firing. And if you do that, you see firms in these sectors are the one that you expect, like firm in accommodation, in clothing, in gambling, performing arts, and so on. These are the firms that are very affected by COVID. What we see is that if you're in a firm that is more affected, that faced a larger shock in 2020, you're going to borrow more, but only if you're large firms. So on the right panel, you can see the large firms, and you see that firms that have a bigger exposure to COVID, that are in more affected sector, they actually borrow more. That's what this x-axis, this y-axis shows. Okay, so that's exactly what you expect. That's what these credit lines are for with the bank, is to borrow on them, to draw on them when you're hit hard by a shock. However, for small firms, this intuitive relationship doesn't exist. We see that even small firms that are in very affected industry, like performing art or clothing, they don't actually draw more than others. And so that tells us there's something wrong. It's not just about the funding needs. It's just being a small firm means that you have a very strict contracts that just prevents you from accessing funds. So the last thing I want to talk about in just a couple of minutes is, this evidence, this big inequality between small and small firm that's dramatic, tells you that, yes, maybe public policy should do something about it. And so I want to just say a word about the Paycheck Protection Program, which is the biggest program that was put in place to try to give SMEs access to more liquidity. So for those of you who don't know about the PPP, I'll just say this is a very generous program of loans, have long maturity, and they are very cheap. Okay, so they're very, very subsidized. They're targeted for small firm, although there was some exceptions. And importantly for the firm, they're basically completely forgivable as long as you keep your employee, your number of employee high enough. Okay, if you cover payroll. Okay. So what we do is we can just see in our data what firms did with these funds, and actually we find a very striking result that firms that borrowers receive funds that borrowers receive from the government, so this PPP money, was basically entirely used to repay bank loans. So basically, about 100% of the amount that these firms received from the government went back to the pocket of banks. And they did repay some outstanding loans that they had with the banks. Now that's striking in two respects. First, we thought this money would go directly in operations of the firms to help them going. Well, what really happened is actually mechanically that it went into the pocket of banks. And second, these firms are repaying loans with banks, but these loans are from 2019 because we saw that in 2020, they actually did not borrow more. Okay, so this is certainly not how policymakers expected the program to work. Okay. So, what would be the takeaway of the talk if I had to summarize it? Is that in normal times, we see that SMEs actually sign loan contracts that are much stricter than big firm, right? It's just completely different ball game. They're very, very qualitatively different contract. And that's going to have big implications for bad times, that when a large cash flow shock arrives, like COVID, firms think they might have some quote unquote dry powder on paper, some funds with their banks that they could use, but actually that overestimates massively what is actually available to them. And what's interesting is that this looks like a credit crunch for small firm that is not due to having a banking crisis. That's what we saw 10, 12 years ago. There was a banking crisis and then a credit crunch. Here, banks' balance sheets are strong. The crisis doesn't come from the banking sector. And still, we saw a credit crunch for small firms. So that tells us that these loan contracts is really something that we should pay more attention to, as they matter a lot in bad times. Okay? I'm just going to stop here in interest of time. Thank you very much.
Thank you so much, Olivier. That was really interesting. I'll just give the audience a few minutes to think about Q&A, but we do have one that came in asking that stating that didn't firms have to show they were using the PPP funds to retain employees? Was there evidence required for the loan disbursement?
Yes. But what's interesting is that money is fungible. So all that was required is that you didn't fire anybody, not necessarily that the funds were specifically used to pay workers. So as long as you didn't fire anyone, you were actually free to use the money for other things. And so what happens is that in practice, the PPP funds that you receive were actually very large for your level. So it's not like, the check was just enough to cover operation for a month. They were bigger than that. So you use some of that to pay for operation for that month. But the rest, what they did is they didn't just keep it in their bank account. They actually repaid previous loan. So they were able to do both at the same time. In some sense, you just have to show that you're not firing anybody. But in principle, these funds, the extra funds, can be used for anything. And here we saw that they used them to give it back to their bank.
Is the technical definition of firing in this context permanently letting someone go, or were businesses allowed to terminate full-time employees and hire them back as PTEs or consultants and still retain the funds?
Yeah, there was some specific details in place. The simplest approach, like the overall approach, was more an accounting number, that the payroll expenses that you have to be relatively constant compared to before. Now, I don't know the exact details about exactly what contractual form you can use, but there was certainly some provisions there.
Okay. So now we have a couple questions related to the cause and effect of inflation. So does this enhanced liquidity, government liquidity, create a danger of inflation? And from a second audience member, the question that, is there evidence that there is a lower risk of inflation if the PPP money went back to the banks and not into the real economy?
Yes, so inflation is on everybody's mind. Everybody is, feel that, since the Federal Reserve balance sheet, like money creation was so big in 2020 and so fast, if you live through the 80s, you're just going to be confident that that's going to mean large inflation, because that's just how we think about macro and monetary economics classically since Milton Friedman. I have to say the jury is still out. We had very low inflation in spite of a lot of action from central banks in the past 10 years. The Federal Reserve has undershot its inflation target for 12 years. I have the feeling inflation is not going to come back just like this, in spite of what Milton Friedman would tell you. But we'll see. I would say that there's no clear direct connection between the PPP and what I discussed today and the price of apples, the price of gasoline at the gas station. So I'm more of a skeptic of classical monetary theory. I think we're not sure. Inflation was not there. It's moving a bit in the market, but in the data, it's not there. It hasn't been there for a long time. So I wouldn't think the direct connection is obvious. And I can see it's interesting that we have audience members that are disagreeing on what's going to happen. I think that reflects our state. But I will say, these are great questions. What drives inflation in a modern financial economy? Probably very different from what drove inflation in the 60s and the 80s. So more great question for future paper. That's all what I'll say.
And another really great question, extrapolating from this, what you could call a potential gap or inefficiency of large bank lending to SMEs, is there a significant amount of growth in loans by fintechs or neobanks to small businesses with the flexibility and the terms and the monitoring efficiencies that large firms enjoy with their larger clients? And which fintechs are most relevant?
Yeah, so that's a great question. Sadly, you know, the charts that I showed you we don't have the data from the fintech, so I can only give you a very partial answer to that, but I think that's a great question. So two important things. The first thing is that fintechs were key in making the PPP program work. So the PPP was this government program. They were giving money to small firms, but you had to apply through a bank to get the funds. You could apply through a traditional bank or through a fintech. Fintech was massively faster, did a lot of lending, and were basically instrumental in getting government funds in the hand of firms. So that they played a key role in the PPP for sure. However, there's still a little question of these fintech lenders are not traditional banks. So they typically don't have very large balance sheets, a lot of deposits, access to funds. So it's actually harder for them to do things that looks like the credit line I discussed today, because credit lines of this very specific product agreement with your bank that you can draw at any time and the bank has to provide you funds very flexibly. And that's very useful if you're like Bank of America, you have a lot of deposits, a lot of a lot of us have our retail deposit there. If you're a fintech that doesn't have that, it's not so easy to do. So I would say the role of fintech, they are very useful in some aspect of credit provision, like the PPP, but in some others, they still have a disadvantage and most firms have to rely on traditional banks. Some of them very local, but not quite fintech yet. Clearly, convenience is much better for fintech, but it's still a little bit of a dual system for some things.
And I'll just note an interesting fact. So last night in the FinTech Innovation Salon, I had Lisa Marchese, who's EVP of corporate development globally at American Express. I had her interview her colleague, friend, and now her friend and now colleague through the acquisition of Kabbage, Catherine Petralia, who co-founded Kabbage, which is a small business lender processing and now with the acquisition by Amex, banking service to SMEs. And they were the #1 PPE distributor, and Bank of America was #2. So you look at that dynamic, and there are efficiencies and better monitoring for more bespoke platforms that don't have to deal with 8 different divisions competing for clients' revenues and oversight. Okay, let me get one more question and then we'll move forward. Okay, hold on. So was there any evidence that banks actually called the short-term facilities so that small firms had to use the PPP money to repay the facilities rather than what they would have wished to do with the funds?
We can't observe the phone calls, so we don't know exactly what was the trigger. It's possible that some of this happened. My feeling is that this was so large, like basically every recipient did that. I'm not sure, that every single recipient of the PPP got a call from their banker. So I think some of it just makes sense as a cash management strategy, right? If the PPP gives me, let's say, $1 million, and my expenses for this month is only 100,000, what am I supposed to do with the next the other 900,000? I will eventually use them. So I certainly don't want to spend them, but should I keep them in cash? But if I have a big loan outstanding, maybe it's more smart for me to actually repay the loan and avoid paying the interest rate. So I think this is what most firms we see that, but we don't see the sole phone calls, and I'm sure that this actually happens occasionally for sure.